I'm Deborah Borchardt, and this is your midday market update. When we look at the indices, they're all in the green territory, seeing a little bit of a bounce here. But is that what this is? Is this a dead cat bounce, or are we buying the dips and now we've decided that all the selling is going to be over? Well, the man that has all the answers is Keith Bliss from Cuttone. Of course, you don't have, a crystal ball. But you can definitely get an idea of where we're going. I mean, is this a dead cat bounce? Are we going to see more selling take place the next negative headline we get? Or are people going, this is a good price, I'm getting back in?
Well, there was a confluence of events. You're right, nothing like putting a little pressure on me with all the answers. But anyway, there were a few things that we picked up. Back in January 24th, when the S&P hit 1804, we called it oversold at that point in time. And then it continued to sell off. One of the indicators that we look at gets it into what we call the ultimate buying opportunity, and it happens when you have a global event, and the emerging markets turned out to be that global event. We actually hit the level yesterday, I'll give you precisely, it was 1742 and 77 cents. Now we traded through that, but we stopped at 41. We found some support there, and we're coming back. Now the answer to your question is difficult to answer today, primarily because we've got to see a few more levels. We got to see the market get above a few more levels. That important level is 1770 on the S&P. If we can get back up there, probably won't happen today, but if we can get back up there and hold, then there's very good reason to think that we'll get back up into the 1800s. And our mark for what our indicator told us last night was to get back up into the 1830 range for the S&P 500. So potentially a dead cat bounce. I don't think we're going to see the massive selling pressure that we saw. There was a bit of a capitulation behavior in the market yesterday when you saw once it took off, everybody just got out of the way and let it go down. So I think, based upon what I've seen, what I've observed over the years, that we should turn around here and move higher. It'll be in fits and starts, but I think we'll move higher back up into the 1800 range for sure.
All right, so you guys were then jumping in and buying when things were going down?
We were telling clients that based upon all the variables that we had in there, that that was a good time to go ahead and stick your nose out there. Your stomach tells you that you don't want to do it, but that's when the best money is made. And we saw that yesterday again at that 1742 and change level. One thing that everybody needs to look at, though, for the last year, and it continues today, is that the 10-year yield is tightly correlated with the equity markets. You see that thing go down, the equity markets are going to go down. We're going to see it rise, and that's clearly a money flow type of activity that's going on. The other thing to look at is the VIX. The VIX, again, is pretty tightly correlated, has gotten back into some symmetry with the S&P 500. You've seen that come off a little bit today. Did get above that 20 level that we talked about last week. So watch that. If you see that generally leads the S&P 500 inside of our work. If you see that start to come in much more rapidly than the S&P 500 is moving up, expect the S&P to move up in lockstep with it eventually.
All right, well, there you go. Keith's telling you to take a look at that 10-year treasury yield and also the VIX. And, of course, the people that make money are the ones that hold their nose and write that buy ticket when the market is going down. You got to buy when everyone else is selling. That's Keith Bliss from Cuttone, and I'm Deborah Borchardt with The Street.